Welcome to Wise Beyond Bitcoin, your favorite place to wise up on crypto. As you know, we started because we support technologies that promote ethics, equality, and harmonious solutions. Prior to the emergence of Bitcoin, our focus was on the study of money, markets, and economics, with an emphasis on liberty, social progress, and spiritual evolution. So it's with excitement that we offer this special episode. As you know, this is an outreach, education, grassroots channel. And if you've never been excited about an economic journal article published on a Federal Reserve website, well, let that sink in because you're about to be. We have recently, just a few days ago, well, officially February 5th of 2021, Decentralized Finance on Blockchain and Smart Contract-Based Financial Markets. This article was just published, Federal Reserve Bank of St. Louis Economic Research Journal. And so, being that our nerdy passion and hobby has always been economics, economic philosophy as a study, I'm going to power through this article with you. I will leave the link below so that you can read it and share it yourself. However, the overall sentiment of this article, it's a great resource. It's very, very well written to explain the nuances. You know, we have a few economic articles on our website that talk about smart contracts, proof of work, and proof of stake. We've actually talked about many of these subjects you'll find in here, you'll find covered in our economics blog. However, this is very well written and in great detail. So I'm definitely going to link this and include this as a resource for people to read in the future. Well, let's get right into it without further ado. This article is by Fabian Share. How do you pronounce that? I should know that, but I do not. All right, well, let's get right to it. The term decentralized finance, DeFi, refers to an alternative financial infrastructure built on top of the Ethereum blockchain. DeFi uses smart contracts to create protocols that replicate existing financial services in a more open, interoperable, and transparent way. This article highlights opportunities and potential risks of the DeFi ecosystem. I propose a multi-layered framework to analyze the implicit architecture and the various DeFi building blocks, including token standards, decentralized exchanges, decentralized debt markets, blockchain derivatives, and on-chain asset management protocols. I conclude that DeFi still is a niche market with certain risks, but that it also has interesting properties in terms of efficiency, transparency, accessibility, and composability. As such, DeFi may potentially contribute to a more robust and transparent financial infrastructure. So you can tell right there that this is very positive outlook. This is very positive for cryptocurrency, especially for a project like Wise Token. As we read through this article, I'm very excited about to share this with you because when you understand the value proposition of Wise Token as a smart contract built on the Ethereum blockchain with having no keys, ownerless keys, being ownerless liquidity locked on a decentralized exchange. As you read this article, when you understand what separates Wise Token from other DeFi cryptocurrencies, um, you'll understand actually much of the value added by Wise Token. So this is a great article for many reasons. It's a great article for cryptocurrency. It's a great article for DeFi, decentralized finance, for Ethereum, even for Polkadot, Cardano, for the chains that are creating interoperable systems, networks. This is just overall, it's well understood how these operations work in this article. It's explained very well, and therefore, um, knowledge is power. And this education, this is great. So let's move up without further ado. I'll contain my excitement over this, and let's get to the introduction. Decentralized finance is a blockchain-based financial infrastructure that has recently gained a lot of traction. The term generally refers to an open, permissionless, and highly interoperable protocol stack built on public smart contract platforms, such as the Ethereum blockchain. It replicates existing financial services in a more open and transparent way. In particular, DeFi does not rely on intermediaries and centralized institutions. Instead, it is based on open protocols and decentralized applications, dApps. Agreements are enforced by code, transactions are executed in a secure and verifiable way, and legitimate state changes persist on a public blockchain. Thus, this architecture can create an immutable and highly interoperable financial system with unprecedented transparency, equal access rights, and little need for custodians, central clearinghouses, or escrow services, as most of these roles can be assumed by smart contracts. DeFi already offers a wide variety of applications. For example, one can buy US dollar pegged assets, so called stablecoins, on decentralized exchanges, move these assets to an equally decentralized lending platform to earn interest, and subsequently add the interest bearing instruments to a decentralized liquidity pool or an on chain investment fund. The backbone of all DeFi protocols and applications is smart contracts. Smart contracts generally refer to small applications stored on a blockchain and executed in parallel by large set of validators. In the context of public blockchains, the network is designed so that each participant can be involved in and verify the correct execution of any operation. As a result, smart contracts are somewhat inefficient compared with traditional centralized computing. However, their advantage is a high level of security. Smart contracts will always be executed as specified and allow anyone to verify the resulting state changes independently. When implemented securely, smart contracts are highly transparent and minimize the risk of manipulation and arbitrary intervention. To understand the novelty of smart contracts, we first must look at regular server-based web applications. When a user interacts with such an application, they cannot observe the application's internal logic. Moreover, the user is not in control of the execution environment. Either one or both could be manipulated. As a result, the user has to trust the application service provider. Smart contracts mitigate both problems and ensure that an application runs as expected. The contract code is stored on the underlying blockchain and can therefore be publicly scrutinized. The contract's behavior is deterministic, and function calls, in the form of transactions, are processed by thousands of network participants in parallel, ensuring the execution's legitimacy. When the execution leads to state changes, for example, the change of account balances, these changes are subject to the blockchain network's consensus rules and will be reflected in and protected by the blockchain's state tree. The blockchain state tree, in this case being Ethereum, and of course, WISE token being a smart contract as an example. Smart contracts have access to a rich instruction set and are therefore quite flexible. Additionally, they can store crypto assets and thereby assume the role of a custodian with entirely customizable criteria for how, when, and to whom these assets can be released. This allows for a large variety of novel applications and flourishing ecosystem. And this is huge because this is what Wise Token has done. It has changed the criteria for how, when, and to whom Ethereum, a digital asset of value, can be distributed. It changed the game theory incentive structure through smart contracts simply to monetize time, to create an ethical monetary standard where we saw proof of work chains centralizing towards people with more computing power. So it's beautiful. This article is very, very beautifully written and explain the nuances, the differences between blockchains and smart contracts and their functions. And as you see, as more people learn the nuances, more people will be able to appreciate the value brought by certain smart contracts on these platforms. Okay. To continue, the original concept of a smart contract was coined by Szabo. Szabo used the example of a vending machine to describe the idea further and argued that many agreements could be embedded in the hardware and software we deal with in such a way as to make a breach of contract expensive for the breacher. Buterin proposed a decentralized blockchain-based smart contract platform to solve any trust issues regarding the execution environment and to enable secure global states. Additionally, this platform allows the contracts to interact with and build on top of each other, composability, layers. The concept was further formalized by Wood and implemented under the name Ethereum. Now, some of these names don't sound familiar. There's Gavin Wood and Vitalik Buterin of Ethereum and Polkadot. Although there are many alternatives, Ethereum is the largest smart contract platform in terms of market cap, available applications, and development activity. DeFi still is a niche market with relatively low volumes. However, these numbers are growing rapidly. The value of funds that are locked in DeFi related smart contracts recently crossed 10 billion USD. It is essential to understand that these are not transaction volume or market cap numbers. The value refers to reserves locked in smart contracts for use in various ways that will be explained in the course of this paper. Figure 1 shows the ETH, the native crypto asset of Ethereum, and USD values as the assets locked in DeFi applications. Recognizing ETH, as the crypto asset of Ethereum, this paper is very well written. Who put this together and the research done shows a good understanding of cryptocurrency markets. It's a pleasure to read this, and I look forward to sharing this article down below in the description so you can read this and share this exciting economic journal article. All right, let's get through to the next. I know you're just waiting with anticipation for me to get to the next section. Here, let's go. I'll come back to this chart. You can look at it whenever you want. Okay. The spectacular growth of these assets alongside some truly innovative protocols suggests that DeFi may become relevant in a much broader context and has sparked interest among policymakers, researchers, and financial institutions. This article is targeted at individuals from these organizations with an economics or legal background and serves as a survey and an introduction to the topic. In particular, it identifies opportunities and risks and should be seen as a foundation for further research. So this article is targeted towards men and women who work in certain fields and with legal backgrounds and economics organizations. So as you can see, they're very optimistic and they do a great job at explaining a lot of the values. So with this kind of an article written directed to people working in these positions of temporal authority, it looks like a very positive outlook. If you're educating people that are working in positions of some sort of authority, then they can take that knowledge and education to help people and to make better decisions. At the moment, the people who are in charge of a lot of things haven't had the ability to understand these technologies that have grown up around them. So the decisions made won't reflect the level of technological growth, the knowledge growth around them. So something like this coming from the Federal Reserve to people who are working that depend upon the Federal Reserve um, is good news, I feel. All right. DeFi building blocks. DeFi uses a multi-layered architecture. Every layer has a distinct purpose. The layers build on each other and create an open and highly composable infrastructure that allows everyone to build on, rehash, or use other parts of the stack. It is also crucial to understand that these layers are hierarchical. They are only as secure as the layers below. If, for example, the blockchain in the settlement layer is compromised, all subsequent layers would not be secure. Similarly, if we were to use a permissioned ledger as the foundation, any decentralized efforts on subsequent layers would be ineffective. Okay, an example, this has happened already in DeFi. There are protocols that have been hacked. There are protocols that have had some cryptocurrency exploits in their aggregated pools, and because of that, they've had to um, sometimes slash the wallets of those who are making up those pools to defray the costs among the people involved. And there are other ways that have been dealt with in the past. But so, if you're building layers and one of those layers is weak and unaudited or has a bug in it, then everything built on top of that layer obviously is flawed. And so that's what it's explaining with a nice little old school graph right here for you to look. The DeFi stack, it's called. Here would be Ethereum. Here would be your WISE contract. Here would be your what's already being built, lending and other protocols that can connect, staking, and all the functions. That might actually be here as it goes directly on, but it might be a protocol layer actually. So you got the staking and the scraping, the CM referral functions, and then there are other application layers and aggregation layers that can be built, which are being worked on at the moment. This section proposes a conceptual framework for analyzing these layers and studying the token and the protocol layers in greater detail. It differentiates between 5 layers as shown in figure 2, the settlement layer, asset, protocol, application, and aggregation layers. The settlement layer consists of the blockchain and its native protocol. Bitcoin on the Bitcoin blockchain, ETH on the Ethereum blockchain. It allows the network to store ownership information securely and ensures that any state changes adhere to its rule set. The blockchain can be seen as the foundation for trustless execution and serves as a settlement and dispute resolution layer. The asset layer, layer 2, consists of all assets that are issued on top of the settlement layer. This includes the native protocol asset as well as any additional assets that are issued on this blockchain, usually referred to as tokens. WISE token would be considered the asset layer on top of the settlement layer, Ethereum, which as a money, as a currency, that's what you would build on the asset layer. WISE token is an asset. It's a digital asset that's backed and redeemable by ETH. The protocol layer provides standards for specific use cases such as decentralized exchanges, debt markets, derivatives, and on-chain asset management. These standards are usually implemented as a set of smart contracts and can be accessed by any user or DeFi application. As such, these protocols are highly interoperable. The application layer creates user-oriented applications that connect to individual protocols. The smart contract interaction is usually abstracted by a web browser-based front end, making the protocols easier to use. The aggregation layer is an extension of the application layer. Aggregators create user-centric platforms that connect to several applications and protocols. They usually provide tools to compare and rate services, allow users to perform otherwise complex tasks by connecting to several protocols simultaneously, and combine relevant information in a clear and concise manner. All right, well, now you understand how blockchain smart contracts work. Let's wrap it up. Now that we understand the conceptual model, let us take a closer look at tokenization and the protocol layer. After a short introduction to asset tokenization, we will investigate decentralized exchange protocols, decentralized lending platforms, decentralized derivatives, and on-chain asset management. This allows us to establish the foundation needed for our analysis of the potential and risks of DeFi. Asset tokenization. Public blockchains are databases that allow participants to establish a shared and immutable record of ownership, a ledger. Usually, a ledger is used to track the native protocol asset of the respective blockchain. However, when public blockchain technology became more popular, so did the idea of making additional assets available on these ledgers. The process of adding new assets to a blockchain is called tokenization, and the blockchain representation of the asset is referred to as a token. The general idea of tokenization is to make assets more accessible and transactions more efficient. In particular, tokenized assets can be transferred easily and within seconds from and to anyone in the world. They can be used in many decentralized applications and stored within smart contracts. As such, these tokens are an essential part of the DeFi ecosystem. Understanding WISE token is a tokenized asset on the Ethereum blockchain that revolutionizes decentralized finance. As we get through this article further, you'll understand one of the things that makes WISE token so innovative is that there are no intermediaries. There are DeFi applications on blockchains that still require trust, that still require faith in third parties, intermediaries, people to be in control, whereas WISE token is completely automated on smart contract protocols and has no foundation developers or owners in control of the direction. So it's immutable and secure in that regard. Continuing, from a technological perspective, there are various ways in which public blockchain tokens can be created. However, most of these options can be ignored as the vast majority of tokens are issued on the Ethereum blockchain through a smart contract template referred to as the ERC20 token standard. These tokens are interoperable and can be used in almost all DeFi applications. Well, isn't that nice to know that WISE token is built on the Ethereum blockchain as all these others can be ignored at the moment? These tokens are interoperable and can be used in almost all DeFi applications. As of January 2021, there are over 350,000 ERC20 token contracts deployed on Ethereum. Table 1 shows the number of tokens listed on exchanges and the aggregated token market cap in USD per blockchain. Almost 90% of all listed tokens are issued on the Ethereum blockchain. The slight deviation in terms of market cap originates from the fact that a relatively large portion of the USDT stablecoin has been issued on Omni. And you'll be able to take a look at the popular smart contract chains that are currently out there in crypto world. And as you see, Ethereum is leading the charge. Now, many people are expecting Cardano and Polkadot to jump up here with the exciting work that's being done on those smart contracts. But who knows? There are others that are doing some great things as well, and they are working to be interoperable as well. So it's not a race to see who wins. It's more of a journey to see who arrives together. As they're a highway, and you don't want to see a highway with one lane. You'd like to see a highway with several lanes that people can choose and change from. From an economic perspective, this is where it gets fun. I am more interested in the asset's nature than in the underlying technical standard used to implement the asset's digital representation. I feel you, brother. The main motivation for adding additional assets on chain is the addition of a stablecoin. While it would be possible to use the aforementioned protocol assets, BTC or ETH, many financial contracts require a low volatility asset. Tokenization enables the creation of these assets. However, one of the main concerns with tokenized assets is issuer risk. Native digital tokens such as BTC and ETH are unproblematic in this regard. Interesting what he just said. He is explained that Ethereum and Bitcoin, that the blockchain, the way that the mining, the way that those algorithms work, that the issuing of Bitcoin and Ethereum, he has recognized that is secure. He recognized that is not an issue or a problem at all. He's moved, so he recognizes, economically speaking, that the fundamentals of these blockchain technology are sound. In contrast, when someone introduces tokens with a promise, for example, interest payments, dividends, or the delivery of a good or service, the corresponding token's value will depend on this claim's credibility. If an issuer is unwilling or unable to deliver, the token may become worthless or trade at a significant discount. This logic also applies to stablecoins. So when you have stablecoins that are issued that are backed by dollars, if the company, the central agency issuing them, if something happens, if there is a hack or something finds out that there is a major fraud or miscounting, and what's backing those stable coins, you could have those stable coins become substantially worthless, a run on the stable coin bank, so to speak. And there have been other smart contracts that aren't stable coins that have been said to do things, and they ended up not being audited or having bugs and being made purposely to be exploited, and they became worthless because of problems in the smart contract operation. Which again, you come to the benefit of WISE token, audited, bug bounty, all of the contract continues to operate as it was explained, as it's designed. Always do your due diligence, always do your research and understand. But this is a great article at explaining the nuances. How exciting it is that this is coming out here in 2021. It's just a beautiful time for cryptocurrency and this technology. Knowledge is power. Make sure as you understand this, you share this with other people, because this article was put together by someone who had a team of people helping him research to understand these concepts so that he can explain this to other people in fields of various in power and finance and in legal fields. So it's important that whether it's your uncle, your brother, your sister, your mom, whoever is working in these because we're all just people working in these jobs together. If you're like, hey, are you going to work in that government job in charge of our finances, honey? Yeah. Well, do you know about this technology to make things easier for all of us? Read up on it so you can change the rules for all of us. That's basically what's going on here. All right. I digress. And now let's progress. Generally speaking, there are three backing models for promise-based tokens: off-chain collateral, on-chain collateral, and no collateral. Off-chain collateral means that the underlying assets are stored with an escrow service, for example, a commercial bank. On-chain collateral means that the assets are locked on the blockchain, usually within a smart contract. When there is no collateral, counterparty risk is at its highest. In this case, the promise is entirely trust-based. Barents, Berenson and Shar have analyzed the three categories in the context of stablecoins. Okay. They're analyzing the context of stablecoins, but you can see this with other smart contract protocols on Ethereum and blockchain. And off-chain would be, well, they're talking about stablecoins like a bridge, I suppose, like Tether or others. But you look at, I'm trying to think off the top of my head, Ren, although it's not a stable coin, Ren Bridge wraps Bitcoin and puts it on the Ethereum network. Ren is a foundation that is technically, even though Ren is a decentralized technology, that the Ren Foundation is centralized in offering what they do. So that would be similar to an escrow service. WISE token, and now there are many smart contracts that have no collateral, little to no collateral. You're just hoping that they deliver on a bunch of promises. WISE token would be the epitome of on-chain collateral. There's nothing like it with on-chain collateral, because the liquidity, the collateral, the Ethereum that was literally put into a pool on chain was locked with ownerless liquidity. So that's the evolution and the revolution there. But let's continue with the stablecoin context. On-chain collateral has several advantages. It is highly transparent, and claims can be secured by smart contracts, allowing processes to be executed in a semi-automatic way. A disadvantage of on-chain collateral is that this collateral is usually held in a native protocol asset or a derivative thereof, and therefore will experience price fluctuations. Take the example of the DAI stablecoin, which mainly uses ETH as its on-chain collateral to create a decentralized and trustless DAI token pegged to the value of 1 USD. Since there is no native USD pegged token on Ethereum, DAI tokens must be backed by another asset. Whenever anyone wants to issue new DAI tokens, they first need to lock enough ETH as underlying collateral in a smart contract provided by the Maker protocol. Since the USD ETH exchange rate is not fixed, there is a need for over collateralization. If the value of the underlying ETH collateral at any point falls below the minimal the minimum threshold of 150% of the outstanding DAI value, the smart contract will auction off the collateral to cancel the debt and DAI. Well, that's beautiful how it automatically does that. The DAI protocol is pretty neat. Figure 3 shows some key metrics of the DAI stablecoin, including price, total DAI in circulation, and the stability fee. That is the interest rate that has to be paid by anyone who is creating new DAI. That being said, volatility, you mentioned volatility, but of course you have more volatility in young markets. As markets grow and more value gets locked in, brought in, as more money comes into a market, then its ability to be volatile decreases. As the larger it gets, the less volatile it becomes. So I digress. Let's continue. There are also several examples of off-chain collateralized stablecoins. The most popular ones are USDT and USDC, both USD-backed stablecoins. They are both available as ERC20 tokens on the Ethereum blockchain. DGX is an ERC20 based stablecoin backed by gold, and WBTC is a tokenized version of Bitcoin, making Bitcoin available on the Ethereum blockchain, as I was mentioning earlier with REN. Off-chain collateralized tokens can mitigate exchange rate risk, as the collateral may be equivalent to the tokenized claim. However, off-chain collateralized tokens introduce counterparty risk and external dependencies. Tokens that use off-chain collateral require regular audits and precautionary measures to ensure that the underlying collateral is available at all times. This process is costly and in many cases not entirely transparent for the token holders. While I'm unaware of any functional designs for unbacked stablecoins, that is, stablecoins that do not use any form of collateral to maintain the peg, several organizations are working on that idea. Well, look, okay, this is coming from the Federal Reserve, so you can't expect anything less. While while I'm unaware of any functional design for creating a money that has no backing that people must use, we're working on it. Well, of course, the purpose of cryptocurrency is to move away from that model. But note that rebase tokens such as Ampleforth or YAM do not qualify as stablecoins. They only provide a stable unit of account, but still expose the holder to volatility in the form of a dynamic token quantity. Although stablecoins serve a vital role in the DeFi ecosystem, it would not do justice to the subject of tokenization to limit the discussion to these assets. There are all kinds of tokens that serve a variety of purposes, including governance tokens for decentralized autonomous organizations, tokens that allow the holder to perform specific actions in a smart contract, tokens that resemble shares or bonds, and even synthetic tokens that can track the price of any real-world asset. Another distinct category are so-called non-fungible tokens, NFTs. NFTs are tokens that represent unique assets, that is, collectibles. They can either be the digital representation of a physical object, such as a piece of art, making them subject to the usual counterparty risk, or a digitally native unit of value with unique characteristics. In any case, the token's non-fungibility attributes ensure that the ownership of each asset can be individually tracked and the asset precisely identified. NFTs usually are built on the ERC 721 token standard. The following sections discuss the protocol layer and examine how tokens can be traded using decentralized exchanges, how they can be used as collateral for loans and to create decentralized derivatives, and how they can be included in on-chain investment funds. Decentralized exchange protocols. As of September 2020, there are over 7,092 crypto assets listed on exchanges. While most of them are economically irrelevant and have a negligible market cap and trading volume, there is a need for marketplaces where people can trade the more popular ones. This would allow owners of such assets to rebalance their exposure according to their preferences and risk profiles and adjust portfolio allocations. In most cases, crypto asset trades are conducted through centralized exchanges. Centralized exchanges are relatively efficient, but they have one severe problem. To be able to trade on a centralized exchange, traders must first deposit assets with the exchange. They thereby forfeit direct asset to their assets and have to trust the exchange operator. Dishonest or unprofessional exchange operators may confiscate or lose assets. It doesn't even have to be that. It could just be, oh, here we go. Moreover, centralized exchanges create a single point of attack and face the constant threat of becoming the target of malicious third parties or state malicious third parties. Aren't hackers. They're often men and women working in positions of authority in state entities that use that to attack the competition. The relatively low regulatory scrutiny intensifies both problems and the immense scaling efforts many of these exchanges had to go through within a short time. Accordingly, it is no surprise that some centralized crypto asset exchanges have lost customer funds. Many examples over the years of centralized exchanges being hacked or having issues with authority, whether it's from hackers or legal issues, and the customer suffering because of that. Hence, DeFi, decentralized finance, growing in value. Decentralized exchange protocols try to mitigate these issues by removing the trust requirement. Users no longer must deposit their funds with a centralized exchange. You keep your money, you keep your keys. Instead, they remain in exclusive control of their asset until the trade is executed. Trade execution happens automatically, automatically, atomatic, oh, atomically, pardon me. Trade execution, trade execution happens atomically through a smart contract. See, I was trying to read some of that one there. Through a smart contract, meaning that both sides of the trade are performed in one indivisible transaction, mitigating the counterparty credit risk. Depending on the exact implementation, the smart contract may assume additional roles, effectively making many intermediaries, such as escrow services and central counterparty clearinghouses, obsolete. Depending on the exact implementation, the smart contract may assume additional roles, effectively making many intermediaries, such as escrow services and central counterparty clearinghouses, obsolete. We have just witnessed a major manipulation or regulatory issue between Webull, Robinhood, these brokerage firms, and Apex and Citadel clearinghouses, the counterparty clearinghouse risk. And the amount of money escrow services, these financial institutions, are how much resources are devoted to these escrow services, these clearinghouses. As an economist, just with the economics mind of the economist, just as a just thinking economically, thinking the value, all of that value that you are able to save. That's the value of these new systems. You understand, when you no longer need these institutions, all the billions, all the billions of dollars that we have devoted to the jobs, to the resources to maintain these institutions, all of those resources are no longer necessary to be devoted. That's the economic thinking, right? The resources model, allocation of resources. So that's a real value. It's a hidden value that this new technology brings. Early decentralized exchanges, such as Ether Delta, I remember that, have been set up as walled gardens with no interaction between the various implementations. The exchanges had no shared liquidity, leading to relatively low transaction volumes and large bid-ask spreads. The high network fees, as well as cumbersome and slow processes to move funds between these decentralized exchanges, have rendered supposed arbitrage opportunities useless. More recently, there has been a move toward open exchange protocols. These projects try to streamline the architecture of decentralized exchanges by providing standards on how asset exchange can be conducted and allowing any exchange built on top of the protocol to use shared liquidity pools and other protocol features. However, most importantly, other DeFi protocols can use these marketplaces and exchange or liquidate tokens when needed. In the following subsections, I compare various types of decentralized exchange protocols, some of which are not exchanges in the narrow sense, but have been included in the analysis as they serve the same purpose. The results are summarized. When he says they're not exchanges, so Balancer is not an exchange, Curve is not, they're liquidity providers where you can pool. I've used many of these to experiment. And what you can do is you can load up your asset into these pools. You can provide liquidity and let them sit there. Now, of course, let me just continue this one thought. You can provide liquidity and let that liquidity sit there. So as other people are operating on these exchanges that use these pools, the people who provide liquidity earn the fees. Keep it simple. All right. Let's see here. And of course, wow, this is beautiful. I'm scrolling down. This is not most popular decentralized. I wonder when this is written. Most popular, having Uniswap at the bottom. That's pretty funny. Okay. Constant function market maker. Bancor, Balancer, and Uniswap would be those considered constant function market maker. They're completely automated. Decentralized order book exchanges can be implemented in a variety of ways. They all use smart contracts for transaction settlement, but they differ significantly in how the order books are hosted. One has to distinguish between on-chain and off-chain order books. On-chain order books have the advantage of being entirely decentralized. Every order is stored within the smart contract. As such, there is no need for additional infrastructure or third-party hosts. The disadvantage of this approach is that every action requires a blockchain transaction. Therefore, it is a costly and slow process for which even the declaration of the intent to trade results in network fees. Considering that volatile markets will require frequent order cancellations, this disadvantage becomes even more costly. For this reasons, for this reason, many decentralized exchange protocols rely on off-chain order books and only use the blockchain as a settlement layer. So what it's saying is every time you make a transaction, it costs money. So if you have a bunch of on-chain transactions that you want to cancel, it's going to cost a bunch of money. So they keep these order books off-chain. So on cancellations don't incur huge network fees. Off-chain order books are hosted and updated by centralized third parties, usually referred to as relayers. They provide takers with the information they need to select an order they would like to match. While this approach indeed introduces some centralized components and dependencies to the system, the relayer's role is limited. Relayers are never in control of the funds and neither match nor execute the orders. They simply, pardon me, provide ordered lists with quotes and may charge a fee for that service. The openness of the protocol ensures that there is competition among the relayers and mitigates potential dependencies. The dominant protocol that uses this approach is called OX. The protocol uses a three-step process for trades. First, the maker sends a pre-signed order to the relayer for inclusion in the order book. Second, a potential taker queries the relayer and selects one of the orders. Third, the taker signs and submits the order to the smart contract, triggering the atomic exchange of the crypto assets. Constant function market maker. Ooh, getting into Uniswap. A constant function market maker is a smart contract liquidity pool that holds at least two crypto assets in reserve and allows anyone to deposit tokens of one type and thereby to withdraw tokens of the other type. To determine the exchange rate, smart contract-based liquidity pools use variations of the constant product model where the relative price is a function of the smart contract's token reserve ratio. The earliest implementation I'm aware of was proposed by Herzog, Benartzi, and Benartzi. Herzog, Benartzi, and Benartzi. Oh, two Benartzis. Adams has simplified the model, and Chen Zhang and Park provide a formal proof of the concept. Martinelli and Mushig, bless me, pardon, Michigan, Generalize the concept for cases with more than 2 tokens and dynamic token weights. Egorov, why can we do first? John, Jim, Dan optimized the idea for stablecoin swaps. In its simplest form, the constant product model can be expressed as xy equals k, where x and y correspond to the smart contract's token reserves and k is a constant. Considering that this equation must hold, when someone executes a trade, we get x plus delta x times y plus delta y equals k. It can then be easily shown that delta y equals k over x plus delta x minus y. Easily seen. Consequently, delta y will assume changes in y will assume negative values for any change in x greater than 0. In fact, any exchange corresponds to a move on a convex token reserve curve, which is shown in figure 4a. A liquidity pool using this model cannot be depleted, as tokens will get more expensive with low reserves. When the token supply of either one of the two tokens approaches 0, its relative price rises infinitely as a result. It is important to point out that smart contract-based liquidity pools are not reliant on external price feeds, so-called oracles. Whenever the market price of an asset shifts, anyone can use the arbitrage opportunity and trade tokens with the smart contract until the liquidity pool price converges to the current market price. The implicit bid-ask spread of the constant product model plus a small trading fee, may lead to the accumulation of additional funds. Anyone who provides liquidity to the pool receives pool share tokens that allow them to participate in this accumulation and to redeem these tokens for their share of a potentially growing liquidity pool. Liquidity provision results in a growing K and is visualized in figure 4b. Prominent examples of smart contract-based liquidity pool protocols are Uniswap, Balancer, Curve, and Bancor. Smart contract-based reserve aggregation. Another approach is to consolidate liquidity reserves through a smart contract that allows large liquidity providers to connect and advertise prices for specific trade pairs. A user who wants to exchange token X for token Y may send a trade request to the smart contract. The smart contract will compare prices from all liquidity providers, accept the best offer on behalf of the user, and execute the trade. It acts as a gateway between users and liquidity providers, ensuring the best execution and atomic settlement. In contrast to smart contract-based liquidity pools with smart contract-based reserve aggregation, prices are not determined within the smart contract. Instead, prices are set by the liquidity providers. This approach works fine if there is a relatively broad base of liquidity providers. However, if there is limited or no competition for a given trade pair, the approach may result in collusion risks or even monopolistic price setting. As a countermeasure, reserve aggregation protocols usually have some centralized control mechanisms, such as maximum prices or minimum number of liquidity providers. In some cases, liquidity providers may only participate after a background check, including KYC verification. The best known implementation of this concept is the Kyber network, which serves as a backbone protocol for a large variety of DeFi applications. Peer-to-peer protocols. An alternative to classic exchange or liquidity pool models are peer-to-peer protocols, also called over-the-counter OTC protocols. They mostly rely on a two-step approach where participants can query the network for counterparties who would like to trade a given pair of crypto assets and then negotiate the exchange rate bilaterally. Once the two parties agree on a price, the trade is executed on-chain via a smart contract. In contrast to other protocols, offers can be accepted exclusively by the parties who have been involved in the negotiation. In particular, it is not possible for a third party to front run someone accepting an offer by observing the pool of unconfirmed transactions. To make things more efficient, the process is usually automated. Additionally, one can use off-chain indexers for peer discovery. These indexers assume the role of a directory in which people can advertise their intent to make a specific trade. Note that these indexers only serve to establish a connection. Prices are still negotiated peer-to-peer. AirSwap is the most popular implementation of a decentralized peer-to-peer protocol. Now, reading this article, AirSwap and what was the other one they mentioned? Bancor, Curve. These are big name. Kyber Network. That was Kyber Network and AirSwap. These are protocols that, after reading this article, if you're new to cryptocurrency and you're in traditional finance, you read this, you're going to want to take a look at Kyber Network and AirSwap and Banker and Curve. Decentralized lending platforms. Loans are an essential part of the DeFi ecosystem. There are a large variety of protocols that allow people to lend and borrow crypto assets. Decentralized loan platforms are unique in the sense that they require neither the borrower nor the lender to identify themselves. Everyone has access to the platform and can potentially borrow money or provide liquidity to earn interest. As such, DeFi loans are completely permissionless and not reliant on trusted relationships. To protect the lender and stop the borrower from running away with the funds, there are two distinct approaches. First, credit can be provided under the condition that the loan must be repaid atomically, meaning that the borrower receives the funds, uses, and repays them all within the same blockchain transaction. Suppose the borrower that has not returned the funds plus interest at the end of the transaction's execution cycle. In this case, the transaction will be invalid and any of its results, including the loan itself, reverted. This is called a flash loan. That's what I was getting to. These so-called flash loans are an exciting but still highly experimental application. While flash loans can only be employed in applications that are settled atomically and entirely on-chain, they are an efficient new instrument for arbitrage and portfolio restructuring. As such, they are on track to become an essential part of DeFi lending. Interesting, and they have been flash loans. Second, loans can be fully secured with collateral. The collateral is locked in a smart contract and only released once the debt is repaid. Collateralized loan platforms exist in three variations: collateralized debt positions, pooled collateralized debt markets, and peer-to-peer collateralized debt markets. Collateralized debt positions are loans that use newly created tokens, while debt markets use existing tokens and require a match between a borrowing and a lending party. The three variations are discussed below. Now, understanding WISE token is a digital asset of value locked on Uniswap exchange. It's very innovative and is an amalgamation of a few of these, of what's the technology is being discussed here. You've got Uniswap, which is an automatic market maker exchange, and serving as a as a as a bank, as a warehouse, so to speak, for the WISE token asset, which is backed by Ethereum, where anyone automatically, with no counterparty, no third-party risk of having those WISE tokens overprinted, of having the Ethereum taken out of the pool, the liquidity taken out. You have a very, very unique system where now collateral lending can come off of WISE tokens, which is already being built. But when you have a token that has an asset like Ethereum that's guaranteed, that's locked to back it, well, now in the smart contract, you can lock that asset and receive a loan in DAI, a loan in stable coins, whatever it may be. All these things are being built. This is how the ecosystem works. Anyone can build it. That's the beautiful thing about this, is just understanding the language and developing on top of the protocol. Let's get to these three variations. Collateralized debt positions. Some DeFi applications allow users to create collateralized debt positions and thereby issue new tokens that are backed by the collateral. To be able to create these tokens, the person must lock crypto assets in a smart contract. The number of tokens that can be created depends on the target price of the tokens generated, the value of the crypto assets that are being used as collateral, and the target collateralization ratio. The newly created tokens are essentially fully collateralized loans that do not require a counterparty and allow the user to get a liquid asset while maintaining market exposure through the collateral. The loan can be used for consumption, allowing the person to overcome a temporary liquidity squeeze or to acquire additional crypto assets for leveraged exposure. To illustrate the concept, let us use the example of MakerDAO, a decentralized protocol that is used to issue the USD pegged DAI stablecoin. First, the user deposits ETH in a smart contract classified as a collateralized debt position, CDP, or vault. Subsequently, they call a contract function to create and withdraw a certain number of DAI and thereby lock the collateral. This process currently requires a minimum collateralization ratio of 150%, meaning that for 100 USD of ETH locked up in the contract, the user can create at most 66.66 DAI. Any outstanding DAI is subject to a stability fee, which in theory should correspond to the DAI debt market's maximum interest rate. This rate is set by the community, namely the Maker token holders. Maker is the governance token for the MakerDAO project, as shown in Figure 3. The stability fee has been fluctuating wildly between 0 to 20%. To close a CDP, the owner must send the outstanding DAI plus the accumulated interest to the contract. The smart contract will allow the owner to withdraw their collateral once the debt is repaid. If the borrower fails to repay the debt, or if the collateral's value falls below the 150% threshold, where the full collateralization of the loan is at risk, the smart contract will start to liquidate the collateral at a potentially discounted rate. Interest payments and liquidation fees are partially used to burn Maker, thereby decreasing the total Maker supply. In exchange, Maker holders assume the residual risk of extreme negative ETH price shocks, which may lead to a situation in which the collateral is insufficient to maintain the USD peg. In this case, new Maker will be created and sold at a discounted rate. As such, Maker holders have skin in the game, and it should be in their best interest to maintain a healthy system. It is important to mention that the MakerDAO system is much more complicated than what is described here. Although the system is mostly decentralized, it is reliant on price oracles, which introduce some dependencies, as discussed in section 3.2. MakerDAO has recently switched to a multi-collateral system with the goal to make the protocol more scalable by allowing a variety of crypto assets to be used as collateral. Another thing to note, he mentions the price oracles. There are more price oracles. Chainlink is a major price oracle, and they talk about the fragility of dependency of a system on a price oracle. Well, if your smart contracts are dependent upon one price oracle, and that one price can be manipulated, that can have an effect, a ripple effect throughout all the smart contracts that depend upon that price oracle. And there is a neat protocol. Let's see if I've written down here. I believe it's called Modify. If you look up Modify, there's a neat protocol Modify that's looking to decentralize the oracle, the price oracle market. So that becomes more decentralized too, which makes manipulating the prices a lot more difficult, less probabilistic, especially when you compare it to how prices are manipulated in traditional finance. I would say ceteris paribus, we're still looking up compared to the systems we're coming from. Collateralized debt markets. Instead of creating new tokens, it is also possible to borrow existing crypto assets for someone else. For obvious reasons, this approach requires a counterparty with opposing preferences. In other words, for someone to be able to borrow ETH, there must be another person willing to lend ETH. To mitigate counterparty risk and protect the lender, loans must be fully collateralized, and the collateral is locked in a smart contract, just as in our previous example. Matching lenders and borrowers can be done in a variety of ways. The broad categories are peer-to-peer and pooled matching. Peer-to-peer matching means that the person who is providing liquidity lends the crypto asset to specific borrowers. Consequently, the lender will only start to earn interest once there is a match. The advantage of this approach is that the parties agree on a time period and operate with fixed interest rates. Pooled loans use variable interest rates that are subject to supply and demand. The funds of all borrowers are aggregated in a single smart contract based lending pool, and lenders start to earn interest right when they deposit their funds in the pool. However, the interest rates are a function of the pool's utilization rate. When liquidity is readily available, loans will be cheap. When it is in great demand, loans will become more expensive. Lending pools have the additional advantage that they can perform maturity and size transformation while maintaining relatively high liquidity for the individual lender. There is a large variety of lending protocols. Some of the most popular ones are Aave, Compound, and DYDX. Figure 5 shows the asset weight borrowing and lending rates for DAI and ETH. For DAI, the figure also includes the MakerDAO stability fee, which should always be the highest rate in the system. Surprisingly, this is not always the case, meaning that some people have paid a price premium in the secondary market. As of September 2020, DAI accounts for almost 75% of all loans in the DeFi ecosystem. Decentralized derivatives. Decentralized derivatives are tokens that derive their value from an underlying asset's performance, the outcome of an event, or the development of any other observable variable. They usually require an oracle to track these variables and therefore introduce some dependencies in centralized components. The dependencies can be reduced when the derivative contract uses multiple independent data sources. We differentiate between asset-based and event-based derivative tokens. We call a derivative token asset-based when its price is a function of an underlying asset's performance. We call a derivative event-based when its price is a function of any observable variable that is not the performance of an asset. Both categories will be discussed in the following sections. Asset-based derivative tokens. Asset-based derivative tokens are an extension of the CDP model described in section 2.3. Instead of limiting the issuance to USD pegged stablecoins, the locked collateral can be used to issue synthetic tokens that follow the price movements of a variety of assets. Examples include tokenized versions of stocks, precious metals, and alternative crypto assets. The higher the underlying volatility, the larger the risk of falling below a given collateralization ratio. A popular derivative token platform is called Synthetics. It is implemented so that the total debt pool of all participants increases or decreases depending on the aggregate price of all outstanding synthetic assets. This ensures that tokens with the same underlying assets remain fungible. That is, redemption does not depend on the issuer. The flip side of this design is that users assume additional risk when they mint assets, as their debt position will also be affected by everyone else's asset allocation. A particular case of asset-based derivative tokens are inverse tokens. Here, the price is determined by an inverse function of the underlying asset's performance within a given price range. These inverse tokens allow users to get short exposure to crypto assets. Event-based token Event-based derivative tokens. Event-based derivative tokens can be based on any objectively observable variable with a known set of potential outcomes, a specified observation time, and a resolution source. Anyone can buy a full set of subtokens for a given event by locking one ETH in a smart contract. A complete set of subtokens consists of one subtoken for each potential outcome. These subtokens can be traded individually when the market resolves. The smart contract's crypto assets will be split among the subtoken owners of the winning outcome. In the absence of market distortions, each subtoken's ETH price should therefore correspond to the probability of the underlying outcome. Under certain circumstances, these prediction markets may serve as decentralized oracles for the likelihood of a future outcome. However, market resolution, and therefore the price, greatly depends on the trustworthiness of the resolution source. As such, event-based derivative tokens introduce external dependencies and influenced may be unilaterally influenced by a malicious reporter. Potential attack vectors include flawed or misleading question specifications, incomplete outcome sets that may render the event unresolvable, and the choice of unreliable or fraudulent resolution sources. The most popular implementation is called Augur. It uses a multi-stage resolution and disputing process that should minimize the dependency on a single reporting source as much as possible. If the token holders do not agree with the designated reporter, they may start a dispute, which should eventually lead to the correct outcome. On-chain asset management. Just like traditional investment funds, on-chain funds are mainly used for portfolio diversification. They allow users to invest in a basket of crypto assets and employ a variety of strategies without having to handle the tokens individually. In contrast to traditional funds, the on-chain variant does not require a custodian. Instead, the crypto assets are locked up in a smart contract. The investors never lose control over their funds and can withdraw or liquidate them and can observe the smart contracts token balances at any point in time. The smart contracts are set up in such a way that they follow a variety of simple strategies, including semi-automatic rebalancing of portfolio weights and trend trading using moving averages. Alternatively, one or multiple fund managers can be selected to manage the fund actively. In this case, the smart contract ensures that asset managers adhere to the predefined strategy and act in the investor's best interest. In particular, asset managers are limited to actions in accordance with the fund's rule set and the risk profile stipulated in the smart contract. The smart contract can mitigate many forms of the principal agent problem and incorporate regulatory requirements by enforcing them on chain. As a result, on chain asset management may lead to lower fund setup and auditing costs. On chain asset management. So we're seeing how the economics article published in the St. Louis Federal Reserve is already hinting that this technology is changing the cost structure. We no longer need the amount of people, the resources that it used to take to manage funds. This is all being automated through smart contracts, on-chain asset management. How many people, how many intermediaries, how many jobs, how many resources have been dedicated to firms managing people's assets? So by substantially reducing these costs, we are essentially redoing how we um, how we do business. People around the world, we're restructuring the market, the economy. That's what's so exciting about this. The exciting, the real exciting, the really exciting things about cryptocurrency and blockchain. It's not, yeah, you can make some money if you buy the right thing at the right time, and luck. It's more luck than anything. Markets are rational in the short run, so it's great to enjoy the rush of being in on this new early tech. But when you realize all of the different markets that this technology is affecting and is changing, it's revolutionizing how we do business. It's revolutionizing how we communicate, how we exchange, and in so doing, understanding how it will revolutionize, how it will change those industries that we won't need anymore, and how it will replace and this dynamic activity. It's very exciting. Where was I? Where were we? Okay, this hot topic. They follow. Okay, we are. Whenever someone invests in an on-chain fund, the corresponding smart contract issues fund tokens and transfers them to the investor's account. These tokens represent partial ownership of the fund and allow token holders to redeem or liquidate their share of the assets. For example, if an investor owns 1% of the fund tokens, this person would be entitled to 1% of the locked crypto assets. When the investor decides to close out the investment, the fund tokens get burned. The underlying assets are sold on a decentralized exchange, and the investor is compensated with the ETH equivalent of the share of the basket. There are several implementations of on-chain fund protocols, including the SET protocol, Enzyme Finance, Yearn Vaults, and Btoken. All of these implementations are limited to ERC20 tokens and Ether. Moreover, they heavily depend on price oracles and third-party protocols, mainly for lending, trading, and the inclusion of low volatility reference assets such as the DAI or USDC stablecoins. Consequently, there are severe dependencies which will be discussed in section 3.2. Both Enzyme Finance and SET Protocol allow anyone to create new investment funds. Enzyme Finance has a focus on building an infrastructure for decentralized funds using smart contract-based rule sets to ensure that fund managers stick to the fund's strategies. Trading restriction parameters such as maximum concentration, price tolerance, and the maximum number of positions, as well as user and asset whitelists and blacklists, are enforced by these smart contracts. The same is true for the fund's fee schedule. SET protocol is mainly designed for semi-automated strategies with deterministic portfolio rebalancing triggered by predefined thresholds, values, and time locks. However, the protocol is also used for active management. Btoken operates as a single fund of funds managed by a community of asset managers through a meritocratic system. Ooh, that's good. Meritocracy. The more successful an individual fund manager is, the greater their future influence on allocating the collective resources. Uniswap's liquidity pool also has some characteristics of an on-chain investment fund. The constant product model creates the incentives for a semi-automatic rebalancing of portfolio weights, while the trading fees generate passive income for the investors. Yearn vaults are collective investment pools designed to maximize yield for a given asset. Strategies are quite diverse, but usually involve several steps and active management. In many cases, these actions would be too expensive for smaller amounts. Moreover, they require that the investor is vigilant and well informed. Yearn vaults mitigate these issues by employing the knowledge of the masses and using collective action to split network fees proportionally among all participants. However, the deep integration of the protocol also introduces severe dependencies, opportunities, and risks. In this section, we analyze the opportunities and risks of the DeFi ecosystem. It lays the foundation for the discussion in section 4. Opportunities. DeFi may increase the efficiency, transparency, and accessibility of the financial infrastructure. Let me repeat that. Let me change that. DeFi does increase the efficiency, transparency, and accessibility of the financial infrastructure. There's no may, it does. Moreover, it's like a car may get you to California faster than a horse from New York. May. I mean, ceteris paribus, everything, if they both work out well, then it will. Moreover, the system's composability allows anyone to combine multiple application protocols, thereby creating new and exciting services. We discuss these aspects in the following subsections. Efficiency. While much of the traditional financial system is trust-based and dependent on centralized institutions, DeFi replaces some of these trust requirements with smart contracts. The contracts can assume the roles of custodians, escrow agents, and CCPs. For example, if two parties want to exchange digital assets in the form of tokens, there is no need for guarantees from a CCP. Instead, the two transactions can be settled atomically, meaning that either both or neither of the transfers will be executed. This significantly decreases counterparty credit risk and makes financial transactions much more efficient. Lower trust requirements may come with the additional benefit of reducing regulatory pressure and reducing the need for third-party audits. Similar efficiency gains are possible for almost every area of the financial infrastructure. Additionally, token transfers are much faster than any of the transfers in the traditional financial system. Transfer speed and transaction throughput can be further increased with layer 2 solutions such as sidechains or state and payment channel networks. Okay, bada bing, bada boom. Wise token, bam. So he understands that a smart contract, layer 2 solutions that for transfer speed, for scalability, that it's there. Efficiency, almost every area of the financial infrastructure. Do you recognize how big this is? This is huge. However, when he mentions reducing regulatory pressure and the need for third parties, lower trust requirements may come with additional benefit. I think it's understating it. Reducing regulatory pressure, we're omitting the need for many of these agencies. Many people who go work in regulatory agencies are working off of a traditional financial model that's based on trust requirements, and we've seen how that works out. When we trust, there's that absolute power corrupts absolutely. Like, oh, and you put any person in a position of power, and it will have some corrupting effect. Well, we look at the traditional financial system where it's highly centralized, and there's a major power structure, very hierarchical. Now we see the potential of moving to a system that revolutionizes, completely changes this. I'm getting sidetracked where I was going with this. It'll come back to me. Let me continue reading. The efficiency gains. I just read these through. I don't edit. I don't cut. So it'll come back to me. I'm just so excited about this. Oh, the regulators, the people that are working in those regulatory fields this is a new technology. It's ridiculous to go to financial regulators of a traditional financial system who spent their whole life trying to understand how to regulate a system that requires trust, because some people can print money that other people depend on and have to use. And some houses can clear transactions and have licenses to do things that other people don't. I mean, there's all these complex nuances. The regulators of today's current traditional system they understand a system that's so complex and nuanced, but it has no bearing in this new DeFi blockchain transparent. It's trustless because it's transparent. The other system we have to trust because it's a black box where people have power. And of course, in that trust-based centralized system, we found every single time, if you have to put your trust in people in power, you're going to be let down. Unless you expect it to do what it does, then you won't be let down. You'll you'll appreciate this though a lot more, I'm sure. Transparency. DeFi applications are transparent. All transactions are publicly observable, and the smart contract code can be analyzed on chain. The observability and deterministic execution allow, at least in theory, an unprecedented level of transparency. Financial data are publicly available and may potentially be used by researchers and users alike. In the case of a crisis, the availability of historical and current data is a vast improvement over traditional financial systems, where much of the information is scattered across a large number of proprietary databases or not available at all. As such, transparency of DeFi applications may allow for the mitigation of undesirable events before they arise and help provide much faster understanding of their origin and potential consequences when they emerge. Could this article have not come at a better time after the lack of transparency and everything that was going on with the clearinghouses, the brokerage firms that halted the purchases of GME and other stocks that were being shorted? So transparency, efficiency, and accessibility. By default, DeFi protocols can be used by anyone. As such, DeFi may potentially create a genuinely open and accessible financial system. In particular, the infrastructure requirements are relatively low and the risk of discrimination is almost inexistent due to the lack of identities. And I'll tell you one even further. Wise token makes it even more accessible because many cryptocurrencies, well, I digress, they're all accessible. Um, if regulation demands access, if regulation demands access restrictions, for example, for security tokens, such restrictions can be implemented in the token contracts without compromising the settlement layer's integrity and decentralization properties. When I was saying accessibility, WISE token has revolutionized accessibility in the smart contract by monetizing time. By monetizing time, it has given everyone equal access to the inflation, to the newly minted money. Whereas we look at traditional finance, the accessibility comes to, well, through special intermediaries, through special places and authority. Special banks will get the newly injected money. They will be able to bid up resources with that new money before other people have access. And then you look at something like Bitcoin, which is an advancement in digital money compared to traditional finance. However, Bitcoin has its flaws where proof of work chains tend to centralization, whereas whoever can afford more computers, better computing power, and more access to energy can afford to make more money. And you have a class of people who become the money makers are those who can afford those access to resources. So again, it still creates a divergence and accessibility. But Wise Token, by monetizing time, it equalizes accessibility to all people in a completely different way. Because I stress cryptocurrency is more accessible in many ways than traditional finance, period, end of story. But Wise Token has taken it to a whole nother level. Composability. DeFi protocols are often compared with Lego pieces. The shared settlement layer allows these protocols and applications to interconnect. On-chain fund protocols can make use of decentralized exchange protocols or achieve leverage positions through lending protocols. Any two or more pieces can be integrated, forked, or rehashed to create something entirely new. Anything that has been created before can be used by an individual or by other smart contracts. This flexibility allows for an ever-expanding range of possibilities and unprecedented interest in open financial engineering. Risks. DeFi also has certain risks, namely smart contract execution risk, operational security, and dependencies on other protocols and external data. We discuss these three aspects in the following subsection. Um, Spoiler alert: Wise Token does not fall under the operational security, as there's no one in charge. It's all automated, and it's not dependent on other protocols or data other than the backing of Ethereum. But it doesn't rely on price oracles, so it doesn't have that dependency or operational security. And the smart contract execution risk has its bug bounty, it's been audited, and it has been running. It made it past its liquidity phase, where the first smart contract fed the liquidity pool and locked on Uniswap, and has been operating ever since. So the smart contract execution phase risk is highly, highly mitigated. I say eliminated because, you know, I'm not a coder, but let's read on through. Smart contract execution. While the deterministic and decentralized execution of smart contracts does have its advantages, there is risk that something may go wrong. If there are coding errors, these errors may potentially create vulnerabilities that allow an attacker to drain the smart contract's funds, cause chaos, or render the protocol unusable. Users have to be aware that the protocol is only as secure as the smart contracts underlying it. Unfortunately, the average user will not be able to read the contract code, let alone evaluate its security. While audits, insurance services, and formal verification are partial solutions to this problem, some degree of uncertainty remains. Similar risks exist in contract execution. Most users do not understand the data payload they are asked to sign as part of transactions and may be misled by a compromised front end. Unfortunately, there seems to be an inherent trade-off between usability and security. For example, some decentralized blockchain applications will ask for permissions to transfer an infinite number of tokens on behalf of the user, usually to make future transactions more convenient and efficient. Such permission, however, puts the user's funds at risk. Okay, what is this saying? In your MetaMask wallet, in your Web3 browser, there have been times where you're interacting with these. I've done this, and you're going to add to a pool. You're gonna add an asset. You're gonna engage with their smart. And they say, hey, they ask you for permission to take more. You don't have to say, you don't have to give them permission to take an infinite number in the future. You can, but some people do that to make it convenient and easy for future transactions to be automatic. But when you leave that door open, it's like if you leave your house door open for your friends to come in, you're also leaving your house door open for someone else to come in. So these are one of those things that are easily, that's a risk that's easy to mitigate. Don't leave your door open. Okay, operational security. Many DeFi protocols and applications use admin keys. These keys allow a predefined group of individuals, usually the project's core team, to upgrade the contracts and to perform emergency shutdowns. While it is understandable that some projects want to implement these precautionary measures and remain somewhat flexible, the existence of these keys can be a potential problem. If the key holders do not create or store their keys securely, malicious third parties could get their hands on these keys and compromise the smart contract. Alternatively, the core team members themselves may be malicious or corrupted by significant monetary incentives or non-monetary incentives. Most projects try to mitigate this risk with multi-sig and time locks. Multi-signature requires M of N keys to execute any of the smart contract's admin functions, and time locks specify the earliest time at which a transaction can be confirmed. As an alternative, some projects rely on voting schemes, where the respective governance tokens grant their owners the right to vote on the protocol's future. However, in many cases, the majority of governance tokens are held by a small group of people, effectively leading to similar results as with admin keys. Some projects have tried to mitigate this concentration of voting power by rewarding early adopters and users who fulfill specific criteria, which range from simple protocol usage to active participation in the voting process and third-party token staking, yield farming. Nevertheless, even when a launch is perceived as being relatively fair, the actual distribution often remains highly concentrated. He brings up a good point. Oftentimes you hear that a launch is fair, but you look at the tokenomics, the token distribution. And again, this is as more people educate themselves and understand these nuances, the value proposition of WISE token just becomes heir apparent. The tokenomics of WISE, the distribution is the most fair, ethical distribution you can find among any token. Virtually 99%, over 96%. A small percent was paid to the team for putting everything together, but it was not a percentage in perpetuity. It was a one-time payment. And you've got over 96, 97% of the tokens of Ethereum backing the token locked. That's the distribution. The distribution is so fair that virtually all of the Ethereum that went into the pool is backing the token, and it can't be removed. Bada bing, bada boom. All right. Governance tokens may lead to undesirable consequences. In fact, did I read this already? No. In fact, a high concentration of power may be given more problematic when these rights are tokenized. In the absence of vesting periods, malicious founders can rug pull by dumping their entire token holding on a CFM, on Uniswap, which has happened before, causing a massive supply shock and undermine the project's credibility. Again, impossible with WISE token. Moreover, yield farming may lead to centralization creep by allowing an already well-established protocol to assume a significant portion of a relatively new protocol's governance tokens. This may create large meta protocols whose token holders essentially control a considerable portion of the DeFi infrastructure. Dependencies, as described in section 3.1. Some of the most promising features of the DeFi ecosystem are its openness and composability. These features allow various smart contracts and decentralized blockchain applications to interact with each other and to offer new services based on a combination of existing ones. On the flip side, these interactions introduce severe dependencies. If there is an issue with one smart contract, it may potentially have wide-reaching consequences for multiple applications across the entire DeFi ecosystem. Moreover, problems with the DAI stablecoin or severe ETH price shocks may cause ripple effects throughout the whole DeFi ecosystem. Now, while this is true, there's the Nirvana fallacy. Look at the current financial system. Look at its dependencies. Literally, the whole financial system right now is extremely fragile and extremely dependent on central agencies and central parties. So while this article is great, it's not. I think it would be also nice to maybe maybe have a more fair comparison to traditional finance when making some of these statements. Let's see. The problem comes apparent when illustrated by an example. Let us assume that a person locks ETH as collateral in the Maker DAO contract to issue DAI stablecoins. Let us further assume that DAI stablecoins are locked in a compound lending smart contract to issue interest-bearing derivative tokens called CDAI. The CDAI tokens are subsequently moved to the Uniswap liquidity pool along with some ETH, allowing the person to withdraw Uni CDAI tokens representing a shared liquidity pool. With every additional smart contract, the potential risk of a bug increases. If any of the contracts in the sequence fail, the UniCDAI tokens could potentially become worthless. These token on top of a token on top of a token scenarios, which create wrapper tokens, can entangle projects in such a way that theoretical transparency does not correspond to actual transparency. That brings up great points, and that's true. When you look at Aave or Compound, when you look at protocols that have many different ERC20 tokens in their platform. Well, if one of those, if a major stablecoin or if a major smart contract protocol were to have a bug or to be flawed, then all the value that brings would be sucked out. So that's important to know. That's the dependency. That's the ripple effect. And you get that in any market. Again, a strength of WISE token is that it is locked by ETH. It's a one-to-one. It's not a one-to-one peg. It's backed. It's just one-to-one. It's WISE token to the ETH asset. I mean, a bridge. It's just that relationship. External data. Another point worth mentioning is that the fact that many smart contracts are reliant on external data. Whenever a smart contract depends on data that are not natively available on chain, the data must be provided by external data sources. These so-called oracles introduce dependencies and may in some cases lead to heavily centralized contract execution. To mitigate this risk, many projects rely on decentralized oracle networks with a large variety of data provision schemes. That's already being done. You have Chainlink, and like I said, Modify. There are, I'm sure, others developing decentralized Oracle solutions. And again, the great thing about WISE token is it does not rely on external data. It doesn't rely on any external data. Illicit activity. A concern. Hold on. A common concern among regulators is the crypto assets may be used by individuals who want to avoid records and monitoring. Is that a common concern? I'm just curious. Is that a common concern? There are people who go to work in government buildings and they have a common concern before they even understand new technology. It's like you're in a horse and buggy industry. You don't even understand cars, but you just have a common concern about the automobile industry. How does that? Regulators, a common concern there to people who want to avoid records and monitoring. While the inherent transparency of DeFi is a deterrent to this use case, I was about to say DeFi is so illicit activity in blockchain technology. It's what's funny is that traditional finance and modern banking has been the bastion of illicit activity, money laundering, billions, millions, hundreds of millions, billions have been going on through traditional finance before blockchain ever. This is just like a new technology that's just come around, and now you have regulators, people working saying, "Hey, I'm worried about people making transactions that I can't see or be aware of." It's like you just it seems like people that want to find out how they can get their cut to avoid records. It's like we don't need your monitoring. We don't need your institution anymore. Your whole system of needing to determine and regulate. We have automated this through smart contracts. We don't need your system. So pick up a shovel and plant something because we could use some good, healthy, organic produce. All right, let's keep going. However, this may not necessarily be a bad thing. And the situation is more complicated than it may seem at first glance. On the one hand, pseudonymity can be abused by actors with dishonest intentions. On the other hand, privacy may be a desirable attribute for some legitimate financial applications. Correspondingly, regulators, the word regulator, you're just people. We're all just people. Correspondingly, regulators should act with great care, trying to find reasonable solutions that allow them to step in where necessary without stifling innovation. Like literally step out. Like the horse and buggy industry should not come and make rules and regulations for the automobile industry. It just makes no sense. It makes no sense. This is my 2 cents to the on this economics article. You just if someone just have a little swallow the pride and say, you know what, I'm out of my forte, I'm in traditional finance. All regulators, all the people who work in traditional finance say, you know what, this is not, I don't, blockchain, crypto, I need to study up on this. This is not my thing. I'm new to this. I shouldn't be in charge of regulating something I don't understand. All right. Moreover, one has to be aware that regulating a decentralized network may not be feasible. Moreover, one has to be aware. I like this article. While it is questionable whether regulators can or should regulate a decentralized infrastructure, you think, there are two areas that deserve special attention, namely fiat on and off ramps, the decentralization theater. This is great. And you know what? I'm glad he said that. It is questionable whether regulators should regulate an infrastructure. Why? Let's give an example. Some people, we've been going to the tribal chiefs to get fire. It's called, we go every year, we go to get fire. Some kids wanders out and figures out you can get two sticks rubbed together and you can make fire. Everyone can make fire themselves. We go back and we show the tribal chiefs and they say, whoa, 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 okay, well, now everyone who used this must give us a little portion of everything you cook. Or the regulators can determine, okay, well, you can use this, but if you're going to use this, you need to pay us a tax for the amount of fire that you're saving that you used to get from us. It's like they're trying to find some way to, instead of just being like straight up tribal chiefs, we don't need you anymore. Just go out and just live like all of us. You're just one of us. You're just another dude or dudette. So that's basically what's happening right here. Um, now, we know the fiat on and off ramp. That's a good point. Right now, it's the creating what the regulators can do. If you're like working for the old chiefs, and you can make it easier for people to get a couple sticks, or in this case, you can make it easier for people to connect from traditional finance into crypto. These on ramps, whether like Coinbase are centralized, traditional, but how people can spend their debit cards, credit cards, their cash, their money, and to engage with the blockchain, the cryptocurrency market, those on and off ramps. They're the interface to the traditional financial system. Whenever people want to move assets from their bank account to the blockchain-based system or the other way, they have to go through a financial service provider. These financial service providers are regulated and may require background checks on the origin of the funds. So the easiest way to help this new technology flourish is to create less barriers to entry and to allow more people to openly go into this new technology. In a similar vein, it is important to differentiate between legitimate decentralized protocols and projects that only claim to be decentralized, but are in fact under the exclusive control of an organization or a few individuals. The former may provide exciting new possibilities and remove some dependencies, while the latter may essentially introduce the worst of two worlds, that is, de facto dependencies on a centralized operator with limited supervision. Keeping this in mind, regulators should watch closely and analyze carefully if a given DeFi protocol is indeed decentralized, or if the DeFi label is just for show, an attempt to get around regulation. Great point. Great point. And you want to look at that? WISE token is that exciting thing he was talking about. It is one of those legitimate decentralized protocols that removes the dependencies. Here we go. Removing dependencies. There is no group in charge. You look at others like I don't. I should do more research into the actual functioning of the protocol, but I do know that there is a centralization when you look at protocols like Celsius, where you have AML KYC, It is decentralized finance, but there is still trust in centralized operators. And there are other protocols too that are built on smart contracts that you still have to trust um, a board of governing tokens, whereas WISE token does not have a board. There is no board governing the direction. It is complete, it's secure, it's immutable, and it's scalable. Blockchains face the ultimate trade-off between decentralization, security, and scalability. While the Ethereum blockchain is generally regarded as relatively decentralized and secure, it struggles to keep up with the great demand for block space. Escalating gas prices and long confirmation times adversely affect the DeFi ecosystem and favor wealthy individuals who can conduct large trades. Potential solutions to this problem include base layer sharding as well as various layer 2 solutions such as state channels, zero knowledge rollups, optimistic rollups. However, in many cases, scalability efforts weaken composability in general transaction atomicity, atomicity, two of DeFi's most prominent features. On the other hand, moving DeFi to a more centralized base layer does not seem to be a reasonable approach either, as it would essentially undermine its main value proposition. Thus, it remains to be seen if a truly decentralized blockchain can keep up with demand and provide the foundation for an open, transparent, and immutable financial infrastructure. However, what's not mentioned is you mentioned Ethereum blockchain. It's the smart contract on the blockchain that can solve the old trilemma trade-off between scalability, security, and decentralization. That is the trilemma. That's the trade-off, and that is what Wise Token has solved by monetizing time as a smart contract on Ethereum. Conclusion: DeFi offers exciting opportunities and has the potential to create a truly open, transparent, and immutable financial infrastructure. Because DeFi consists of numerous highly interoperable protocols and applications, every individual can verify all transactions and data is readily available for users and researchers to analyze. DeFi has unleashed a wave of innovation. On the one hand, developers are using smart contracts and the decentralized settlement layer to create trustless versions of traditional financial instruments. On the other hand, they are creating entirely new financial instruments that could not be realized without the underlying public blockchain. Atomic swaps, autonomous liquidity pools, decentralized stablecoins, and flash loans are just a few of many examples that show the great potential of this ecosystem. While this technology has great potential, there are certain risks involved. Smart contracts can have security issues that may allow for unintended usage, and scalability issues limit the number of users. Moreover, the term decentralized is deceptive in some cases. Many protocols and applications use external data sources and special admin keys to manage the system, conduct smart contract upgrades, or even perform emergency shutdowns. While this does not necessarily constitute a problem, users should be aware that in many cases there is much trust involved. However, if these issues can be solved, DeFi may lead to a paradigm shift in the financial industry and potentially contribute toward a more robust, open, and transparent financial infrastructure. That's it. Bada bing, bada boom. We powered through it. I'm going to link this article below. This is exciting news. So, this is exciting news for cryptocurrency, for decentralized finance. Remember, Bitcoin started out as DeFi. Bitcoin is DeFi. Originally, Bitcoin was meant to be decentralized finance. It is meant to be digital money, a store of value. So it's decentralized storage and it's a financial instrument. It's the original DeFi. There are problems with Bitcoin, and people have seen that over the years. It paved the way. This is a great article because this is showing how Ethereum, being a blockchain like Bitcoin, but one to host dApps, decentralized applications, that when it comes to more dynamic and growing value in the world of decentralized finance, that this is the future. This is more efficient, and it allows for more complex and more nuanced applications. So, point case in point would be Wise Token. You're able to solve the centralization problems with Bitcoin, and you can create an ethical monetary system that monetizes time, that treats people equally, as we all value our time. equally subjectively to ourselves. All right. I'm going to link this article below. This is just great news for Ethereum, great news for Polkadot, Cardano, great news for smart contract blockchain. This is basically saying, hey, you know what? Bitcoin's great, but you guys need to look at decentralized finance, look at smart contracts, look at how blockchain technology is opening up a whole nother world of DeFi. How do you support us? Well, at the moment, if you don't know how to join Wise Token, we were inspired to teach about cryptocurrency and its revolutionary, evolutionary impact because of this beautiful protocol. If you don't know about it, come check out our website. We are revamping it to be more crypto DeFi education friendly in general, but we will always maintain a special place in our heart focused on supporting and onboarding people to an ethical and equal and transparent cryptocurrency. After that article, you can even more understand now why Wise Token is so special in cryptocurrency and so valuable when there are so many protocols out there and there's so much risk in this wild west world of digital finance, decentralized finance. It's nice to have a blue chip stock. It's nice to know of something that's like, okay, so we don't have the malicious, we don't have the counterparty risk, we don't have this unended, unfinished roadmap. It's nice to have something that you can count on in this world of DeFi. So scroll down, check it out, read about it. We've got the teal paper to learn about Wise Token. You can check out the price chart there. Scroll on down. The only way to support us at the moment is follow the steps, and then you come and you stake your 10%. So when you stake your Wise Token, you earn interest and you add value to the network. You are your own bank, and that is how Wise Tokens work. Grab it on Uniswap. You heard me mention Uniswap in the article, the world's largest decentralized exchange. Well, let's go take a quick look at Uniswap, because this is where you're going to go when you go get your Wise Token with Ethereum. It's on the Ethereum network, Wise Token. Uniswap, the world's largest decentralized exchange, bada bing. You click on charts if you want a little more information. And you can see that right now we've got $4.36 billion and growing. And you've got your Wise Token. Bam. $117 million in liquidity. That's not the pair. That's just Wise Token alone. We've read about DAI stable coins. There's the Uniswap governance token. He was talking about governance tokens in the article. Tether USD stable coins, wrapped Bitcoins. So after reading that article, you can come in and look at this CMM, this automated market maker exchange through smart contract protocols. You can look at some of these tokens that are on this blockchain, and you can start to understand more of this ecosystem. This is an educational channel. We continue to research and read and share more of this content so that we can all grow in our understanding together. Knowledge is power. This is a new technology, so let's share and empower each other. If you want to share the love, take those Wise tokens that you got here. Make sure you put your ETH on top. You swap it out. Always keep a good balance of Ethereum. Need to keep Ethereum to pay for your contracts, to pay for your transactions. You take that Wise token and you want to lock it up to earn interest with no third parties, no counterparty risk. Literally just lock it up, an ETH bond in time, and it will grow and grow over time. Click that little link. It will give you 10% bonus for your interest that you earn, and it will share the love to us. You get 10%. You click stake. You're going to connect your MetaMask, your wallet. You're going to connect regular stake. You're going to put in how much you want to stake for a year, 2, 3 years. Let it sit, let it grow, let the markets do their thing, and you do your thing, and you come back to it. You get your 10% bonus shares. It earns interest. You pay it forward. You share the love. That's all it takes to start. We got more information. We got a video that walks you through it. Boom. How do I do it? We walk you through all 3 steps. How do I stake? We walk you through it. Live action, live example. Hey, I'm really excited to share this with you. A lot of changes on this website. Cool things are coming to Wise Token. We have cool things coming. Other people have cool things coming in the community. What a beautiful year for crypto. What a beautiful year for Wise Token. What a beautiful year. Until the next day, have a beautiful day. Namaste. Thank you for your time and interest in our labor of love. We share our work to plant seeds of abundance and prosperity for a more harmonious way. This is not financial advice, and we encourage you to do your own research. We are not paid or sponsored, and we do not seek your money or investment. To show us love and pay it forward, just use our referral link in the description or at wiseboundbitcoin.com for claiming your 10% bonus crypto. And remember to like, subscribe, and share. If you disagree with our views, feel free to share with someone you find disagreeable.